What do you get when each year you group the 12 companies with the largest market capitalizations together? The Mighty Dozen. PTR continuously monitors the group's investment and fundamental performance, seeking insight into the performance of large versus small companies, valuation trends, and trends in the overall market. Welcome to Price Target Research. I'm John Lafferty. In this video, we're going to take a close look at the Price Target Research Mighty Dozen, a group of the 12 largest companies by market capitalization with annual refreshes, and seek to understand the importance of the performance of the group relative to the overall market and to the economy. The very largest companies have always been admired for their high quality, their relatively low risk, for their past performance, for their current dominance, for their global reach, and their easy access to capital. The Mighty Dozen has a current total market cap of about $10 trillion, representing about 21% of the total market cap for the universe at $49 trillion. You can see the current members of the group as of the end of 2020, as well as their respective market caps arrayed according to size. Apple has been at the top of the list for a number of years. And you can see the 21% share calculation at the bottom. The current market value share for the group is about in the middle of the historical range. We have tracked this group over time. It's not always the same companies year over year, but you can see that the group had a high market cap share of about 27% at the beginning of the period, a low of about 6 or 7 years ago, and the current value of 21% is roughly right in the middle of the historical range. It's really not a surprise that the dozen's share of total market capitalization has tracked quite closely with its share of total net income. As you can see in the chart, the red line is the dozen's share of total net income. The green line is its share of total market cap. With the exception of 3 spikes, the two have tracked quite closely together. The first spike occurred after the terrorist attacks in 2001. The second was the subprime crisis in 2008 through 2009. And the current spike reflects the COVID-19 crisis, in which the earnings of smaller firms have been substantially reduced relative to the much more resilient larger firms in the dozen. So you can say with, I think, some assurance that the current spike for the dozen reflects the difficult economy for everyone else. Let's look at large company investment performance relative to investment performance of the smallest companies. As a first measure, the chart shows the change in aggregate market value for the Mighty Dozen since the beginning of 2021. And you'll notice that the group as a whole has suffered a $90 billion decline in aggregate value, while the universe has risen about $3 trillion. This obviously could be viewed as the beginnings of a trend where smaller companies begin to gain net income share relative to the economy as the economy recovers. Another indication is the performance, investment performance of big versus little companies. The PTR universe consists of about 4,000 companies. This chart shows that performance of that universe absolutely with the bold line and relative to the S&P 500 with the light line. So the performance of the universe represents all companies, so lots and lots of small companies involved. And the performance of the S&P is largely big companies. So this downtrend in which the universe has underperformed the S&P 500 for almost a decade is an indicator of how poorly small companies have performed relative to large ones. You can see that trend is about 10 years old. And it's only in the recent months that trend could be viewed as maybe bottoming out. which would be a significant development because of the implications that would have for the overall economy. Another measure is to look at all the largest market cap companies versus the smallest market cap companies. And that's what the red line is it's the total return performance of a group of the very largest market cap companies relative to the total returns of a group of the smallest market cap companies. Again, about a 10-year trend where the largest companies have significantly outperformed the smallest companies. And again, in the last few months, perhaps some indication that that long-term trend is being reversed. The final thing to look at with respect to the Mighty Dozen is the investment performance of the group. We've tracked the performance of each company each year and then linked those aggregate results for the group together to come up with a 20-year performance history. And in looking at it, the performance is almost exactly in line with the S&P 500. In the chart, the bold line represents the total return performance of the Mighty Dozen over the last 20 years. The light line under it is the performance relative to the S&P 500. When the light line is rising, the dozen is outperforming the S&P 500. When the light line is falling, the Mighty Dozen is underperforming the S&P 500. As can be seen, the relative performance over the entire 20-year period for the dozen is flat, meaning that its performance was virtually the same as the S&P 500. It's interesting that superior operating performance by the companies included in the Mighty Dozen every year does not translate into superior investment performance. The logical conclusion is that superior operating performance was already baked into the stock prices. But you have to ask yourself the question, is the Mighty Dozen a high-quality, low-risk, low-maintenance index fund? Once a year to be rebalanced and then not addressed until the following year, allowing the company's attractive investment characteristics to take over. Food for thought. That's it for this examination of the Mighty Dozen. You can find Price Target Research on the web at pricetargetresearch.com and videos at YouTube/Price Target Research. Additionally, Price Target Research content is available exclusively on metrics.com.